So, back on January 1st, 2024, a whole new set of tax laws kicked in across Nigeria. Now, the idea was huge: simplify everything, modernize the economy, a really ambitious plan. But as we've all started to live with these new rules, a much closer look is revealing some serious bumps in the road.
Look, the goals were fantastic: make things fairer, more efficient, and help Nigeria compete on the world stage. But here's the thing. A really deep analysis by the auditing firm KPMG has uncovered some major errors, gaps, and things that were just left out. And these issues could actually end up hurting the very goals these laws were meant to achieve. So let's get into what they found. All right, so here's how we're going to break this all down. We're going to look at KPMG's findings in three main parts. First, the straight-up mistakes in the text. Second, the crucial information that's just missing. And third, the big policy questions that are hanging in the air. Then, we'll wrap it all up by looking at what needs to be done next by both the government and by businesses on the ground.
To really get your head around the problem, an expert used this fantastic analogy. It's like building this amazing, complex Lego castle. The vision is incredible. But what if the instructions are wrong? What if the pieces are mislabeled? The whole thing, as impressive as it looks, could be really unstable. And that's the risk we're looking at here. Okay, let's dive into our first pillar: inherent errors. These are the most obvious problems, things like direct contradictions, typos, and mistakes that are written right there in black and white in the law itself. Okay, check this out. It perfectly highlights the risk of double taxation. The new law brings in a 4% development levy, which is supposed to replace the old police trust fund tax. But, and this is a really big but, it never actually got rid of the old law. So as things stand right now, a business could technically be on the hook to pay for the police fund twice. You can see how that kind of confusion is a major headache for any business. And it doesn't stop there. Here's another direct clash. The new Tax Act says you have to apply a withholding tax on insurance premiums you pay to companies outside Nigeria. But then, a completely separate brand new regulation says the total opposite, that those same premiums are exempt. So which rule do you follow? It's a recipe for total confusion and, honestly, a lot of legal battles down the road. It's not just these big, glaring conflicts either. The law is literally filled with smaller mistakes that cause huge problems. This table here just shows a few examples of incorrect cross-references. Now, you might think, oh, it's just a typo, but imagine being a finance director trying to follow a legal document where the references constantly point you to the wrong section. It makes trying to do the right thing an absolute nightmare. All right, that brings us to pillar 2. Here, we're not talking about what the law says wrong, but what it doesn't say at all. These are the critical gaps, the missing pieces of the puzzle that leave everyone guessing. This is a perfect example, and it's almost unbelievable. The new law says every single individual has to file an annual tax return. That's a huge step, right? But it completely forgets to mention when it's due. There's no deadline. And yet, there are very clear penalties for filing late. How can you possibly be penalized for missing a deadline that doesn't even exist? And believe me, the list of gaps just keeps going. The law creates a new tax for deep offshore oil companies, but forgets to include the tax rate. There's a paragraph in one of the schedules that is literally an unfinished sentence. A really key term for business partners, principal place of residence, is never actually defined. And then there's this procedural mess with that, where the online portal makes it physically impossible to get a filing extension because you have to pay before you can file. It just doesn't work. Okay, so this brings us to our third and final pillar, the really big policy issues. We're moving beyond typos and gaps now. These are complex rules and potential oversights that could have a massive effect on foreign investment and Nigeria's whole economic game plan. So let me ask you a question, because this is at the heart of one of the most talked about new rules. Should Nigeria be able to tax a deal that happens completely outside of the country? This is what Section 47 of the Tax Act is all about. Let's break it down. The source material gave us this brilliant way to explain it. Imagine two kids in a totally different school trade stickers. But your school demands one of the stickers just because those kids happen to be sitting on your school's bus when they made the trade. That's basically it. If two foreign companies make a deal, Nigeria can now tax that deal if they just happen to have a subsidiary here. Now, it's meant to stop tax dodging, but you can see how it might also scare away foreign investors. All right, now let's bring this down to the individual level, to how it affects people day to day. Take a good look at this number, 500,000 naira. This is the new maximum amount of rent relief a taxpayer can claim in a year. So here's why that number is such a big deal. The new rules seem simple, right? A cap of 500,000 naira. But the old rule was actually way more generous for a lot of people because it was partly based on your total income. What this new, simpler rule actually means for many Nigerians is, well, a tax hike. It reduces the money they have in their pocket at the end of the day. And this next one, wow. This could be a massive blow to one of Nigeria's key economic goals, diversification. It seems that the tax exemption that encourages businesses to export things other than oil has just disappeared from the law. Now, was this a deliberate policy change or a massive oversight? The fact that nobody knows is a huge problem for that whole sector.
So after all that, you have to ask, who's the referee here? Who makes sure these laws are actually fair in the first place? Well, there's a new Joint Revenue Board for that. The only problem? The board is made up of government employees from the very agencies that collect the taxes. It's like having the coach of one team also be the referee for the big game. It raises some serious questions about independence, doesn't it?
Okay, so we've laid out a lot of problems. It sounds pretty grim, but it's not all bad news. The analysis doesn't just stop at pointing fingers. It actually offers a really clear path forward. And that call to action is summed up perfectly in this quote from KPMG's report. They're saying in no uncertain terms that it is absolutely critical for the government to go back and fix these issues if they want these laws to have any chance of succeeding.
So how do we fix this? Well, it's not just on the government. It's really a two-pronged approach. The government absolutely needs to act and amend the law. But businesses can't just sit around and wait. They have a huge role to play in getting ready for this new reality. For the government, the to-do list is pretty clear. Fix the errors, fill the gaps, and give us a straight answer on big policy questions like that export exemption. For businesses, the work has to start right now. You need to analyze how this affects your company, get all your paperwork in order, train your finance teams, and, this is a big one, update your accounting and payroll systems to actually handle these new complicated rules. You know, at the end of the day, this is what it all boils down to. A good tax system can't just be about bringing in more money for the government. It has to strike that delicate balance. It has to create an environment where businesses want to invest, where jobs are created, and where the whole country can experience real sustainable growth. So the roadmap for fixing this is there. It's crystal clear. The stakes couldn't be higher. We're talking about everything from major foreign investment down to the amount of money in the average person's pocket. The only real question left is, how quickly can these corrections be made to secure the country's economic future?